All right, let's talk about something kind of wild. What if one of the biggest, most successful stocks out there, a company that's just shattering every record in sight, is actually a bargain? Well, today we're diving into a really fascinating piece of equity research on NVIDIA to see why the market might be getting this story all wrong.
So check this out. On one side, you have an absolutely monster earnings report. I mean, revenue is up 62% from last year. That just blows all the expectations out of the water. But then you look at the stock, and it's been getting hammered, dropping over 7% in just a few weeks. Record profits, but a falling stock. That's the paradox we're digging into.
So what's the deal? Is this some kind of major warning sign that we should all be paying attention to, or is the market just missing something huge? This research report tackles that exact question, and we're going to walk through what it found step by step. Okay, to solve this puzzle, the report starts with the elephant in the room, all the fears floating around in the market. These are the headwinds that are pushing back against NVIDIA's insane growth, and we got to understand them before we even look at the company's numbers. The first big worry is all about interest rates. The market's getting a little spooked that the Federal Reserve might hit pause on cutting rates. And you can think of higher interest rates as being like gravity for these high-growth tech stocks. It just pulls them down by making their future profits seem less valuable today. So investors get nervous and start tapping the brakes.
The second headwind, it's all about geopolitics. The U.S. is keeping the pressure on, tightening restrictions on AI chip exports to China, and this isn't some abstract headline either. A recent pretty high-profile smuggling case really brought this whole issue to life, making people worry that even tougher rules could be on the way. But here's where the report flips the script. It argues that this smuggling story, it isn't just about risk. It's actually a massive signal of something else, a, quote, desperate, insatiable demand for NVIDIA's technology. It just goes to show how essential their chips are, to the point where people are willing to break the law to get them.
Okay, so we've looked at the market's fears. Now, let's look at the other side of the equation, how the company is actually doing. This is the fundamental bedrock that the report says everyone is ignoring because of all the noise.
First up, let this number sink in. $57 billion. And that's not their yearly revenue. That's the revenue for a single quarter. I mean, to put that into perspective, that's more than what the old school giants Intel and AMD made, combined. The scale here is just, it's on another level.
Now, for this one, 73.4%. That is their gross margin. For a company that actually makes and sells physical things, a number that high is just, it's absolutely mind-blowing. It's the kind of margin you expect from a pure software company, and it basically means they have so much pricing power, they can charge whatever they want.
And if you thought those numbers were staggering, get a load of this, $500 billion. The report says this is the company's visible pipeline of future orders for their next-generation Blackwell and Rubin chips. Having that much future business already locked in, it's practically unheard of, especially in the super volatile chip industry.
So how in a world do you even begin to value a company that's growing this fast? Well, the report uses a really important tool called the PEG ratio. To put it simply, it's a way to check if a stock's price actually makes sense when you compare it to how fast its earnings are growing. It's the perfect way to look at a hypergrowth company like NVIDIA.
And this is the number the report calculates for NVIDIA's PEG ratio, 0.78. Now, a number by itself doesn't mean a whole lot, but in investing, as you know, context is everything. And here it is. This is the key takeaway. A PEG ratio that's below 1.0 has historically been a really strong signal that a stock might be undervalued. So yeah, despite the huge price tag per share, the core argument of this report is that when you actually factor in its ridiculous growth, NVIDIA is cheap.
And to really drive this point home, the report doesn't just look at NVIDIA in a vacuum. No, it puts them in the ring, head-to-head against their biggest competitors in the semiconductor world.
Now, this table shows something fascinating. Just look at the forward PE column. You've got NVIDIA, the clear leader with 62% growth in those insane 73% margins, and it's trading at a lower multiple than its main rival, AMD. The report says the market is basically pricing AMD for a perfect comeback while pricing the current, undisputed champion for a slowdown that the data just doesn't show. And when we look at the most important market of all, the data center, NVIDIA's dominance is just on a whole other planet. Their data center revenue alone was over $51 billion.
That single part of their business is bigger than what Intel and AMD are expected to make combined.
So, you've got this market fear on one side and this incredible fundamental strength on the other. How does the report tie it all together? Well, it lays out a concrete, actionable playbook for how to approach this whole paradox. First, they look at the stock chart. The report is clear. The stock is in a correction, and it points to a few key price levels to watch. You can think of that $160 to $165 range as a potential bargain zone, and that price around $153 as the ultimate line in the sand that needs to hold. So, based on those levels, the analyst's advice isn't to just go all in at once. Instead, they recommend a really disciplined scale-in strategy. Buy a little bit now, then set an order to buy a bigger chunk if the price drops to that first support level, and then keep some powder dry in case it hits that final line in the sand. It's a really methodical way to build a position and manage your risk.
And that really brings us back to the ultimate question at the very heart of this analysis. Is the market's focus on all these short-term fears creating a rare opportunity to own the leader of the entire AI revolution at a fundamental discount? According to this deep dive report, the answer to that is a resounding yes. Thanks for tuning in.